Elon Musk has publicly and vehemently criticized President Donald Trump and congressional Republicans for their support of the so-called Big Beautiful Bill that is currently making its way through Congress. Elon Musk has said that this bill is a disgusting abomination that greatly increases U.S. deficits and debts to unsustainable levels. Musk has raised alarms saying that Congress is spending America into bankruptcy and that due to the escalating debt burden caused by the federal debt, America is on the fast lane to debt slavery. The question that I want to address in this video is Elon Musk's characterization of the United States' debt and deficit situation accurate? Is the extreme level of outrage that he's expressed justified? And finally, and most importantly, how should U.S. investors be factoring in the U.S. deficit and debt situation in their investment decision making? So the first step in our analysis is to take an objective look at the facts about U.S. deficits and debt. Total U.S. federal debt as a percent of GDP is at around 123%. However, debt held by the public as a percent of GDP is 98%. And it's this latter figure that is actually the more important figure because it's debt held by the public that actually generates net interest payments that the US government needs to make on its debt. Now let's talk briefly about the deficit. The deficit refers to the amount of money that the US spends that is in excess of the revenues that it collects. And right now, the US federal deficit as a percent of GDP is 7%. Every year that the United States has a deficit, it adds to the total stock of debt that the United States owes. Now, based on this basic information, let's take a look at the Big Beautiful Bill and see how it's projected to impact both deficits and debt. According to the Congressional Budget Office, the CBO, and also other organizations that track this issue, the Big Beautiful Bill is expected to add to U.S. deficits starting in fiscal year 2026. In fact, between fiscal year 2025 and 2034, during those 10 years, the U.S. deficit is expected to increase by a total of $2.5 trillion during that period of time than what the baseline estimate of the deficit was before the Trump administration took office. In other words, the Big Beautiful Bill is projected to make the deficit situation even worse than it was before President Trump took office. Now, as a result of these deficits added by the Big Beautiful Bill, the debt to GDP ratio of the United States is expected to go from 98% to 122% during those 10 years. Now, there's a little bit of a hitch in this issue, and it's a very important issue that people understand, which is that the CBO's scoring of the Big Beautiful Bill does not include the impact of taxes collected through tariffs. The CBO separately did a scoring of the revenues that would be collected as a result of tariffs, and they concluded that tariffs would generate approximately $2.5 trillion during those 10 years. Therefore, the $2.5 trillion in revenue that will be collected over these 10 years as a result of tariffs essentially offsets the increase in the deficit that's being caused by the Big Beautiful Bill. Now, what does this mean? This simply means that at least under the Big Beautiful Bill and Trump's overall fiscal plan, the deficits of the United States over those 10 years isn't going to actually get any worse than it was projected to be before Trump took office. In other words, the situation was really bad before Trump took office, and Trump taking office, he's not actually going to make the deficit any worse, but he's actually not going to make it any better, really. Now, it's going to actually get a little bit better because GDP will grow during this period of 10 years. And so the projected debt as a percent of GDP is actually going to fall modestly according to calculations from the 122% that I mentioned earlier down to about 119%. So instead of the debt going from 98% of GDP to 122%, it's only going to go from 98% to 119% of GDP. This is the thing that Elon Musk is really disappointed about, because instead of stabilizing the debt to GDP ratio, instead of improving the fiscal situation in the United States, the fiscal debt as a percent of GDP is actually going to continue to grow under President Trump. In other words, instead of solving this problem, it seems that President Trump isn't going to really be solving this problem at all. Now, since it seems pretty evident that the debt and deficit situation isn't going to really be resolved during the Trump administration, the question emerges: how high can the debt to GDP ratio get before the United States enters into a terminal crisis? And the second question we're going to explore is: how long will it take for the United States to get to this threshold? Now, there's several estimates out there by reputable economists and organizations on what the absolute threshold is that the United States can have in terms of its debt to GDP ratio. There's one estimate out there by something called the Penn-Wharton model that estimates that the maximum debt to GDP ratio that the United States can really handle before getting into a serious debt crisis is somewhere between 175% and 200% of GDP. Now, Goldman Sachs, using a model developed by the International Monetary Fund, the IMF, has estimated that this threshold is actually somewhere between 160% and 183% of GDP. Therefore, between these two estimates and a series of other estimates, the approximate range where we're going to reach a threshold of how high US debt can get, this threshold is met somewhere in the range of 160% of GDP to about 200% of GDP. So the question is, based on the current trajectory, based on the trajectory that has been set in motion by the big, beautiful bill, including the revenues from tariffs mentioned a minute ago, how long would it take the United States until it actually reaches this threshold, particularly the lower end of this threshold? Now, I've made some calculations on this personally, and it turns out that it takes about 20 to 30 years based on the current trajectory before the United States reaches this sort of critical threshold level where it faces a crisis where it'll either be forced to default on its debt or to implement inflationary policies in order to try to inflate its way out of the debt. Now, my calculations are also verified by Goldman Sachs and the Penn-Wharton model. They all have estimates of this amount of time that's very similar to this 20 to 30 year range that I've just mentioned to you. Therefore, the first observation that I'd like to make for you is that the United States is not on the threshold to imminently get in a situation where it's either going to have to default on its debt or go into a serious inflationary situation. Essentially, the United States has 20 or 30 years to potentially get its act together before it reaches sort of a terminal crisis. But just because it'll take 20 or 30 years to get to a terminal crisis doesn't mean that there aren't going to be any negative consequences for this fiscal indiscipline and the fact that the fiscal situation in the United States is currently out of control. There's going to be some real world impacts to this. And in fact, those impacts are already being felt right now in the US economy. Now, I'm just going to give you a few examples where these very real effects of this fiscal and deficit situation being out of control are currently affecting the US economy. For example, real interest rates, that means inflation adjusted interest rates in the United States, are currently at around or very close to a 17-year high. And they're much higher than they are in pretty much any other developed country in the world. Now, this is something that raises the cost of capital in the United States and makes US businesses, for example, less competitive. And it also means that certain productive projects that might otherwise have been undertaken simply won't be undertaken. Another effect that we're seeing is that the spread between the 10-year US Treasury bond and the 30-year US Treasury bond is actually very high, and it's risen a lot during the past year as a result of these fears. What this particular spread is signaling is that the market doesn't necessarily expect the United States to have a lot of problems necessarily in the next 10 years. But looking 30 years out, the market is a lot more concerned, and that's why this particular spread has widened quite a bit. Now, this may sound a little theoretical, but this actually has real world impacts, because the 30-year Treasury yield is something that essentially determines the price of the 30-year mortgage rate that Americans pay when they're going to buy a house. And 30-year mortgage rates right now are very near a 23-year high. So the fact that mortgage rates are near a 23-year high is a direct effect of this deficit and debt situation raising interest rates. In fact, US mortgage rates are higher than they are in just about any other developed country. So these impacts are very real. Now, there's some other impacts. In one of my other videos that I'll link to here, we've already discussed the fact that credit default spreads for US debt have widened very considerably over the last few months. And in fact, credit default spreads, which essentially insure investors against the risk of default, have actually risen to levels that are similar to those of Greece and Italy. And in fact, US credit default spreads are actually higher than those of Portugal and Spain. And US credit default spreads are certainly a lot higher than other nations that have a similar credit rating as the United States. So we can see here a very clear market concern about US debt being expressed in the CDS market. Now, there's some other markets that are clearly expressing this. The US dollar has dropped by more than 10% in just the last 5 months. This is an indication that the people in the global economy, in global markets, are worried about the long-term health of the US dollar. Now, this concern about the US dollar is also being reflected in gold prices. Gold prices are at an all-time high in real terms. The purchasing power of gold right now is at an all-time high. It's actually at an all-time high going all the way back to before the 1600s, which is really incredible. And what this indicates is the gold market is pricing in the risk of really high US inflation at some point in the future. And this fear of high inflation comes about precisely because markets are worried about US deficits and debts being out of control. So based on all these examples, I think you can see that the problems that are being caused by US debts and deficits are not theoretical. They actually have real world impacts. And these real world impacts aren't going to just come about 20 or 30 years from now when and if the United States gets into a terminal crisis, a terminal debt crisis. Those impacts are already being felt right now, and those impacts are going to get worse gradually over time unless the United States gets a hold of this situation. In other words, as US debt to GDP ratio goes from 98% and rises in the next year to 119% and rises in the following 10 years after that to 150% or more. Each step along the way, real interest rates in the United States are going to be getting higher. There's going to be higher degrees of financial instability in US markets. There's going to be a lot of real world consequences that are going to be felt prior to reaching that terminal crisis. So it is actually very important that the United States try to get this issue under control. So I want to get back to the question that we started with at the beginning of this video. Is the rage and anger expressed by Elon justified? Now, if Elon Musk's statements on these issues are meant to imply that the United States is about to experience some sort of a debt crisis in the short term, then I think that his words are a bit exaggerated. But if what Elon Musk really means is that he's simply upset that the Trump administration and Congress isn't doing enough about this problem right now that could turn into a real crisis in 20 or 30 years, and that is actually having a negative impact on the economy right now, then based on what we've just discussed, those concerns that Elon Musk has are well supported by the actual data and by estimates that have been made by the CBO, by Goldman Sachs, by the Penn-Wharton model, and by a lot of other economists, including myself. So I think it's very important to make some distinctions here. On the one hand, the United States isn't on the verge of an immediate crisis. On the other hand, the United States can't afford to be complacent because these debt and deficit situations are already creating real problems now, and they could create massive problems in 20 or 30 years. But another very important thing to take into account is something that I covered in my last video. In my last video, I discussed what would it take to actually solve the US debt and deficit situation. And what we reviewed there is that it would actually be less difficult to put an end to this whole debt and deficit problem than a lot of people seem to think. A lot of people are very pessimistic and think that US debts and deficits are already so high that it's hopeless. There's really no way that the United States can resolve this problem without either defaulting on its debt or experiencing high inflation. But what I showed in that last video is that that's actually not true. So through some relatively modest cuts to spending and through some relatively modest actions to raise revenues, the United States can actually stabilize its debt to GDP ratio at the current level. And by doing that, essentially would eliminate the risk that is now being faced of this debt and deficit situation sort of escalating and getting out of control in 20 to 30 years. Now, the final question that I want to address is, what should investors be doing in light of everything I just discussed? Well, a couple of things. The first and most important thing is investors shouldn't be panicking on the basis that something's going to happen right away. There's a lot of investors that are out there buying a lot of gold and buying a lot of Bitcoin based on the idea that a crisis is around the corner. This is not actually true. And a lot of investors are actually underweight equities and bonds and some other things as a result of exaggerated fears of an immediate crisis. On the other hand, it's also not true that debts and deficits don't matter and that investors don't need to take this into account in their investing. They actually really do, because as I pointed out before, debts and deficits are already creating a lot of problems in the US economy and particularly in financial markets. And anybody who manages a portfolio is going to need to change the way that they manage their portfolios in light of these problems. Now, I personally have two different portfolios where I apply different strategies to take advantage of the new environment that we're going to be living in during the next few decades as a result of US debt and deficit problems. And one of those portfolios is something called Successful Portfolio Strategy. It's on the Seeking Alpha marketplace. This is a conservative portfolio, and it's something that's appropriate for almost any investor. And then I have another portfolio, which is called the Crisis Opportunity Portfolio, which is a portfolio that is much more aggressive, that uses options, and that essentially is there to try to take advantage of major crises and rebounds that occur from those crises. It's meant to take advantage of big time volatility. Now, the Successful Portfolio Strategy portfolio also takes advantage of this volatility, but it does so in a less aggressive fashion. So both of these portfolios have strategies that are specifically designed for an environment that we're living in today that's a lot more risky than the environment that we lived in 20 years ago. Because 20 years ago, truly, US debts and deficits really didn't matter. They weren't at a high enough level yet relative to GDP that it really had an impact on the economy. But US debts and deficits are already so high that they are having an impact on the economy. And as we can see, they're projected to have an ever larger impact on the economy. And these are things that have real world effects that we need to account for as investors as we set our portfolio strategies. So thank you very much for joining me, and we'll see you next time.